Hey everybody, it's Will at VIP Mortgage and it's time for your local lender update. As is to be expected, bonds are in worse shape today. Last week we saw kind of a step in the wrong direction as well, and that's really because of the situation deteriorating around the Straits of Hormuz. Of course, you probably heard that we've been bombing them. The president has declared that the ceasefire is over, and things are getting a little more uncertain over there. So far, oil prices have gone up about 4% in response to this, and of course that sparks inflation worries. What's really going on behind the scenes is Fed related. Last week there were some comments by one of the voting members that was very significant. First, they were talking about the ways in specific that they're going to track inflation that has an emphasis more on real-time data. He also said that the Fed's long-term projections, especially during COVID, probably caused more inflation than the market would have done on its own, and that lends credence to Fed Chair Warsh's opinion that they really shouldn't be giving a lot of forward-looking advice and let the market conditions dictate what the economy does rather than stated Fed policy or projections or their dot plot chart that shows where they think the economy is going to go. And that makes a lot of sense, rather than the Fed trying to guide the market by giving their insights and projections. Let the data actually show what's going on there. That being said, as I have quietly been watching, the chance of an actual overnight lending rate increase has gone up significantly, and that makes sense. I've been saying actually since January that that's the right move. When I talk to folks in our local market, I haven't said that on the videos yet, and that is the right move because inflation is being stubborn, and lowering rates prematurely can cause inflation to accelerate. There's a lot of factors that go into that, and of course we're going to see a longer term inflationary push from the oil prices increasing than we may have thought in March and April. With that being the case, they're also taking a look at some really important things that contribute to inflation but are not actually inflationary. One great example is if you have money invested, the stock market goes up, the value of your assets goes up, you end up paying your broker or whatever platform you're using, you end up paying them more money when you actually made a lot of money. It's not actually an inflationary cost. So they're looking really into these details to see what they should be tracking, how they should track it. There's some debate on some of the proposals on whether that's actually better than what they've been doing, because some of that real-time data is, rather than backward-looking data, which is what they've used traditionally, some of that real-time data can be really hard to figure out what the trend is going to be, and then you have to figure out how to throw out outliers and things like that. Long story short, would not surprise me if we see an overnight lending rate increase. The bond market's already kind of priced that in. If you look at what interest rates have been doing, and you track that with the bond market chart, it looks like the bond market's been thinking that for a while anyway. So now you're informed. It shouldn't be a surprise to you, and it shouldn't be a panic. We're not talking about a big change in the overnight lending rate, and like I said, mortgage rates have already priced it in. If there's anything we can do for you, give me a call, 719-232-7553.